Most people think the next crash will be just another recession. They're wrong. What's coming in 2025, 2026 isn't a dip, it's a reset. For the first time in modern history, we're seeing 3 debt supercycles, a housing bubble bigger than 2008, and a monetary unwind larger than 1929, all converging. The signs are visible: collapsing bond markets, a $90 trillion shadow debt, and the Federal Reserve quietly preparing liquidity backstops no one's talking about. This isn't fear-mongering, it's math. And when math meets leverage, the result is catastrophe. What happens next could rewrite the global financial order and your place in it. Let's break down how it all unravels, step by step. The crash never starts with panic. It starts with optimism, with smiling anchors on CNBC, with analysts saying, "This time is different," with the quiet confidence that the people in charge, the Fed, the Treasury, the central banks, know what they're doing. But they don't, because every financial collapse in history has followed the same rhythm: euphoria, denial, destruction. And right now, we're deep inside that first act, the calm before the collapse. Look around. The markets are breaking records. CEOs boast about record profits while quietly laying off staff. Households swipe credit cards to survive, convinced that inflation is temporary. And in Washington, officials celebrate a soft landing, as if the economy can simply glide past the laws of math and debt. Most people think this confidence means safety, but history tells us it's the most dangerous signal of all. In 1929, stockbrokers bragged about the new era of wealth. People mortgaged homes to buy shares on margin, and newspapers called it innovation. In 2008, it was the housing bubble. Families bought homes with 0 down loans because real estate never falls. Even Ben Bernanke assured the public that subprime is contained. They weren't just wrong, they were delusional. And now, 2025 is writing the same script. Corporate America is buried under over $13 trillion in corporate debt, the highest in history. Many of these companies are zombies, firms that earn just enough to pay the interest on their loans, but never the debt itself. They exist because of a decade of artificially low interest rates. Money so cheap that inefficiency could masquerade as genius. But here's the twist. When rates rise, these zombies die. And one by one, they're already starting to. Meanwhile, stock buybacks, the illusion of prosperity, are hiding the rot beneath. Companies aren't growing earnings, they're manipulating the math. By shrinking their share count, they make profits look higher even when revenue is flat or falling. It's financial theater. And the audience, the investors, the pensioners, the everyday 401k holders, are clapping, unaware the stage is on fire. Every signal that once warned of danger is flashing red. The yield curve, an economic seismograph that has predicted nearly every recession since the 1950s, is now the most inverted in been in decades. Translation: short-term rates are higher than long-term rates, meaning investors have lost faith in the future. Liquidity, the lifeblood of markets, is drying up. Banks, once flush with stimulus money, are tightening lending. Shadow funds are pulling cash. Global money supply has started contracting for the first time since 2008. And inflation? It's sticky. Not the runaway kind that grabs headlines, but the slow, corrosive kind that eats paychecks month after month while policymakers celebrate progress. Most people believe collapses come from panic, but the truth is more sinister. They come from illusion, from believing that someone else will fix it, from trusting the same institutions that caused the fire to put it out. The economy doesn't fall because of chaos. It falls because of complacency. Because no one wants to admit that the music has stopped until it's too late. This is why markets look strongest right before they break. It's why the Titanic was called unsinkable. It's why investors still buy stocks even when every indicator screams danger. Because denial is comforting, and comfort is fatal. Right now, we preview in that eerie silence before the wave hits. The moment when the sky looks calm, but the air tastes like static. Central banks are tightening, households are stretched. The world is over-leveraged and overconfident. The same psychology that fueled every historic crash is once again in full motion. The certainty that someone else will stop it. But this time, there's no one left to stop it. Because the entire system, governments, corporations, consumers, is leveraged to the same lie. That you can print wealth forever without consequence. And when that lie finally collapses, it won't be gradual. It will be sudden, violent, inevitable. Because when the system looks its strongest, that's when it's already breaking. Debt is invisible until it isn't. It doesn't crash all at once. It swells quietly in the background, hidden in balance sheets and government reports no one reads. Then, one day, the system reaches a point economists call debt saturation, the moment when adding more fuel no longer makes the fire grow. That's where we are now. For decades, debt was sold as a miracle drug. Politicians called it stimulus. Corporations called it leverage. Families called it opportunity. Every generation was told the same lie. Borrow now, pay later. Growth will cover it. But the math stopped working long ago. In the 1950s, $1 of debt created over a dollar of growth. By the 1980s, that same dollar produced about 70 cents. Today, it's less than 50. The U.S. economy is running on a treadmill that's no longer moving, sprinting harder, borrowing faster, yet getting nowhere. The numbers are staggering. $35 trillion in federal debt, larger than the entire U.S. economy, and $90 trillion more in hidden promises. Pension shortfalls, Medicare gaps, and off-book liabilities that politicians pretend don't exist. It's not a debt crisis anymore. It's a debt addiction, and the withdrawal will be brutal. History offers a cruel pattern. In 1929, Wall Street borrowed to buy stocks, margin debt. In 2008, homeowners borrowed to buy houses, mortgage debt. Now, in 2025, everyone is borrowing to buy time. Governments are running deficits during boom years. Corporations issue junk bonds to fund stock buybacks instead of innovation. Consumers swipe credit cards just to afford groceries. And behind the scenes, the Fed quietly monetizes it all, printing digital money that circulates through the veins of a terminally ill system. This is the illusion of prosperity. The idea that wealth can be created without productivity, simply by issuing more IOUs. But debt doesn't disappear. It compounds. And eventually, it devours the very growth it was meant to create. Here's the hidden truth. Every dollar created in this system is born as debt. Money isn't printed, it's borrowed. When you take a loan, you create new money. When you pay it back, that money vanishes. So the only way to keep the system growing is to keep borrowing more, forever. That's why the Federal Reserve can't stop inflation without killing the economy. That's why every recovery feels weaker than the last. We're trapped in a machine that must expand endlessly or collapse instantly. Economists call this the Keynesian endgame, when stimulus stops stimulating and debt stops generating growth. Central banks respond the only way they know how, by pretending they still have control. They raise rates to fight inflation, then panic when markets wobble and flood the system with liquidity again. It's monetary whiplash, a cycle of overcorrection that erodes confidence faster than it fixes anything. And behind the curtain, the numbers no longer add up. Interest on U.S. debt will soon exceed defense spending. By 2026, it could surpass the entire federal budget for healthcare. We've entered the phase where the interest on debt becomes the debt. The Fed knows it. Treasury knows it. They can't hike without breaking markets. They can't print without breaking the dollar. So they stall, hoping time will save them. But time, like credit, eventually runs out. This is the moment right before deleveraging, when the global economy realizes the math doesn't work anymore. It's not just about numbers on a screen, it's psychological. When investors stop believing debt can be repaid, they stop lending. When credit stops expanding, the illusion ends. Money stops moving. And when money stops moving, everything else does too. We've seen this movie before, but never on this scale. The margin call of 1929, the subprime collapse of 2008. Now, in 2285, we face the everything bubble, sovereign, corporate, and personal, all inflated together, all ready to burst together. And when the first domino falls, it won't be random. It'll be the direct result of decades of borrowing against a future that no longer exists. Because the truth is simple. Every empire collapses, not from enemies, but from debt. The Federal Reserve was built to control crises, not to become one. Yet, in 2025, the world's most powerful central bank has trapped itself in an impossible paradox. Every move it makes to save the system destroys it. To tame inflation, the Fed must raise interest rates, but with over $35 trillion in federal debt, every rate hike bleeds the government dry. Each percentage point now costs hundreds of billions in additional interest payments, more than the U.S. spends on defense. And when those payments grow faster than tax revenues, something breaks. So, to stabilize, the Fed does the opposite. It prints more liquidity, more quantitative easing, more digital dollars injected into a system already drowning in them. It calms the markets for a moment, while quietly devaluing every dollar in existence. That's the monetary doom loop. Fight inflation and break the debt market, or print money and destroy the currency. Either way, confidence, the foundation of the financial system, begins to crack. Here's the part most people never hear on the news. The Fed itself is technically insolvent. Its balance sheet is loaded with over $7 trillion in bonds and mortgage-backed securities, assets it bought during the pandemic years when rates were near zero. Now that rates have surged, those same assets are bleeding value every single day. If the Fed tried to sell them, the bond market would implode overnight. So it doesn't. It just sits on them, quietly accumulating losses and pretending they don't exist. In the private sector, that's called bankruptcy. In the public sector, it's called policy. Every crisis the Fed fixed since 2008 came from the same medicine. cut rates, print money, buy time. But after 15 years of artificial cheap credit, the body has built immunity. The drug no longer works. Now, every injection of liquidity only feeds inflation. Every rate hike only increases the risk of default. This is how a central bank loses control, not through a crash, but through credibility erosion. Because the Fed's true product isn't money, it's trust. And when that trust evaporates, so does the illusion of stability. Let's look at the timeline. In 2020, the Fed's balance sheet was $4 trillion. By 2023, it hit $9 trillion, the largest monetary expansion in human history. When inflation exploded, they tried to reverse course, quantitative tightening. But as soon as markets trembled, they backpedaled, reintroducing emergency lending programs to maintain stability. In reality, they were just plugging holes in a sinking ship. This is the invisible cost of confidence. Every time the Fed intervenes, the market becomes more dependent on it. Investors no longer trust fundamentals, they trust the Fed. But what happens when the Fed itself is the risk? We're beginning to find out. Foreign nations, once happy to hold U.S. treasuries, are slowly backing away. China, Japan, and even Saudi Arabia have cut their treasury holdings to the lowest levels in years. They've seen the trap. America's debt is unpayable, its central bank cornered, its currency weaponized. When the buyers of last resort stop buying, who's left? The Fed itself, forced to purchase U.S. debt with money it creates out of thin air. It's the snake eating its own tail. Every stall, every pivot, every emergency program buys time at the expense of credibility. And credibility, once lost, doesn't come back. Here's the quiet truth no one in Washington wants to admit. The Fed isn't steering the economy anymore. It is reacting to it. Each decision is damage control for the last. They're not managing inflation. They're managing panic. But panic is contagious. And when markets realize the most powerful financial institution in the world is trapped by its own policies, confidence evaporates faster than liquidity. That's when money stops being belief and becomes fear. The Fed's real crisis isn't on its balance sheet. It's in the minds of investors, banks, and citizens who once believed the system was unbreakable. Because once that faith breaks, no interest rate or stimulus package can fix it. And quietly, behind polished press conferences and sanitized headlines, that confidence is already eroding. You can't print trust, you can't borrow stability, and you can't raise rates high enough to stop a psychological collapse. The warning signs were there, but few wanted to look. In early 2023, 3 U.S. regional banks imploded within days: Silicon Valley Bank, Signature Bank, and First Republic. Their balance sheets were supposedly solid, their deposits insured. Their collapse? Contained, the media assured us. But that was the first lie, because beneath that calm surface, something much larger was already breaking. Not in one sector, not in one state, but in the foundation of the entire banking system itself. Here's what most people missed. When the Federal Reserve raised interest rates faster than at any time in history, it detonated a time bomb buried inside the banking world. During the pandemic, banks loaded up on long-term government bonds, safe assets, at near zero interest rates. But as rates rose, the value of those bonds plunged. By late 2024, American banks were sitting on over $650 billion in unrealized losses. That's not contained, that's radioactive. In accounting terms, those losses don't count until the bonds are sold. So banks simply decided not to sell. They labeled the losses held to maturity. In other words, we'll pretend this money still exists as long as we never touch it. It's the financial equivalent of hiding cracks in a dam with fresh paint. Meanwhile, depositors noticed. Quietly, steadily, billions began leaving regional banks, flowing into money market funds and treasuries that actually paid interest. This deposit flight drained liquidity faster than in 2008. The problem? Banks need deposits to survive. Without them, they re-forced to borrow short-term money from the Fed's emergency lending windows, programs that didn't even exist a decade ago. As of 2025, usage of these facilities has exploded to record levels, rivaling the panic of the pandemic itself. The official narrative still insists everything is fine. But the data says otherwise. Balance sheets are shrinking, loan growth is collapsing, and trust, the most precious currency in banking, is quietly disappearing. This isn't just another subprime moment. This time, the contagion spreads far beyond bad mortgages. Commercial real estate is imploding as office towers sit half empty. Private credit funds are leveraged to risky corporate loans. Even U.S. Treasuries, once the gold standard of collateral, are under stress as buyers vanish. When every layer of the system depends on borrowed confidence, the slightest tremor can trigger an avalanche. And here's what makes 2025 different: the speed of panic. In 2008, it took days for fear to ripple through markets. In 2023, $42 billion left Silicon Valley Bank in a single day, not from lines of anxious customers, But for apps, a few taps on a phone, a few clicks online, that's all it takes now to drain a bank dry. This is digital contagion. Faster, silent, unstoppable. One viral tweet, one rumor on social media, and billions vanish overnight. No regulator can stop it. No bailout can keep up. Imagine a system built for 20th century risk, now facing 21st century velocity. That's not stability. That's a ticking clock. Behind closed doors, regulators know this. They've quietly relaxed accounting standards to buy time. Banks are merging under government supervision. The Fed has rolled out new backstops, modern euphemisms for bailouts. But each of these measures only masks the decay beneath, because the real problem isn't liquidity. It's transparency. The public no longer knows which banks are safe and which are already zombies hiding behind creative bookkeeping. And when trust becomes uncertainty, uncertainty becomes panic. The truth is simple. The banking crisis never ended. It just went underground, buried under accounting tricks and quiet rescues. The fuse is still burning. We just can't see how long it is. And when it finally reaches the powder, the blast won't stop at regional lenders or Silicon Valley deposits. It will race across borders, through bonds, currencies, and stock markets. Because in a globalized system, one nation's solvency is everyone's illusion. When America catches a cold, the world gets sick. But when America collapses, the entire global system rewrites itself. That's not poetic exaggeration. It's structural reality. Because the world's financial bloodstream runs on one thing, US dollars. And when that dollar wavers, every country, company, and citizen tethered to it feels the quake. Right now, the world is sitting on a powder keg built from American liquidity. Every major economy, Europe, China, Japan, emerging markets, depends on the flow of US dollars to keep their system stable. When the Fed prints, global markets boom. When it tightens, they suffocate. In Europe, that squeeze has already begun. Energy costs surged when dollar-priced commodities spiked, driving nations like Germany, once an industrial powerhouse, into an identity crisis. Factories shut down, inflation soared, political anger simmered, and in China, the second largest economy in the world, the fallout looks even worse. The property sector, once the engine of its middle class, has imploded. Over $9 trillion in household wealth has evaporated, and ghost cities stretch for miles across provinces that once symbolized prosperity. Japan? It's holding the line with yield curve control, printing yen to keep interest rates low, even as its currency collapses. The cost? The yen's weakest level in 40 years, and a slow-motion crisis that's forcing pension funds and corporations to panic buy US dollars just to survive. But the real nightmare begins when those dollars disappear, because every time the Federal Reserve raises rates, the supply of dollars around the world contracts. That means nations that borrowed in dollars, from Turkey to Brazil to South Africa, must repay debts in a currency that's now stronger than ever. It's a trap with no exit. They can't print dollars. They can't borrow more. And they can't default without imploding their economies. This is why the IMF quietly calls the current moment a liquidity stress event. In simpler terms, the oxygen is running out. In 2008, the collapse of Lehman Brothers triggered a chain reaction. Banks froze, markets seized, credit vanished. But back then, the crisis revolved around $700 billion in toxic mortgage assets. In 2025, the potential epicenter is exponentially larger, the $25 trillion US bond market, the very collateral the world uses as risk-free. If US treasuries start to lose value, if confidence cracks, the entire global financial architecture could unravel overnight. Because treasuries aren't just bonds. They're the foundation for every loan, every trade, every derivative, every promise that makes the modern economy function. The entire world has been borrowing against an assumption that America's debt is the safest asset on earth. But what happens when the safest asset becomes the most dangerous one? Most nations don't go bankrupt because they made bad choices. They go bankrupt because they're trapped inside a bad system. A system where the same currency that fuels their growth also determines their downfall. When the dollar strengthens, their debt explodes. When the dollar collapses, their imports skyrocket, and inflation destroys them from within. It's a financial vice, and 2025 may be the moment it tightens shut. Imagine trillions fleeing US markets into safe havens like gold, commodities, and foreign currencies, only to rebound into chaos abroad. That's not diversification, that's contagion. The ripple effects are already visible. Argentina's peso collapsing by the week, Turkey's lira losing over 80% of its value since 2020. African and Southeast Asian economies scrambling for dollars as if they were oxygen tanks in a burning building. This isn't a market correction. It's a monetary realignment, a reordering of global power, value, and trust. And the first tremor will not come from Wall Street. It will come from the bond market, the $25 trillion pillar holding up the global economy. When it cracks, everything tied to it moves. currencies, commodities, nations, lives. Because in a dollarized world, America's crash isn't just America's problem, it's everyone's. History has a rhythm, a pulse that beats beneath every empire, every economy, every illusion of permanence. It's the rhythm of debt, greed, and forgetting. Every 80 to 100 years, the world resets, not through war or plague, but through finance. 1720, the South Sea Bubble. Investors poured fortunes into a company that did almost nothing, all because the Crown said it was safe. The result? A nationwide collapse that wiped out the British elite. 1840s, the railway mania. Britain's Industrial Revolution turned into a frenzy of speculation. Railway stocks traded like lottery tickets. When the bubble burst, half the lines were never built. 1929, stock leverage. People borrowed to buy stocks they couldn't afford, believing prices could only go up. Within a year, the market lost 90% of its value. 2008, mortgage derivatives. Households, banks, and governments believed debt was wealth, until the illusion shattered. 2025, it's the same song, new instruments. The pattern is what Ray Dalio calls the long-term debt cycle. Short-term booms and busts come and go, but roughly once every century, the entire system reaches a breaking point, when total debt becomes so large it can be inflated or refinanced away. We are at that point now. The symptoms are textbook. Exploding wealth inequality, asset bubbles everywhere, stocks, real estate, crypto, bonds. Social division between those who own assets and those who rent their lives from them. And the final sign, distrust in money itself. Every collapse begins when people stop believing their currency has value. Rome clipped its coins until silver disappeared. Spain debased its currency with stolen gold from the New World. Britain overextended its empire, printing pounds to maintain control. And America? It's repeating every one of their mistakes at once. When Dalio warned of the end of the long-term debt cycle, he wasn't predicting doom. He was describing math. Because there comes a moment when the compounding stops working. When every dollar of new debt produces less growth, and when governments promise what they can't pay, and citizens still demand more. When printing money stops feeling like stimulus and starts feeling like theft. That's not politics, that's arithmetic. History doesn't repeat, it compounds. Each cycle grows faster, more global, more digital. The bubbles are bigger, the leverage deeper, the consequences wider. And each collapse doesn't just erase wealth, it transfers it. Every reset consolidates power upward. The middle class gets hollowed out. Assets move from weak hands to strong. It's the oldest story in economics. Creative destruction for the few, real destruction for the many. The fall of an empire rarely looks like fire and blood. It looks like inflation. It looks like distrust. It looks like a government printing more money to solve problems caused by money. By the time Rome fell, no one trusted its coins. By the time the British Empire faded, the pound had lost 90% of its value. And now, the US dollar, the reserve currency of the world, is showing the same cracks. Debasement, deficits, denial. This fall won't be moral. It won't be ideological. It will be mathematical. A simple equation finally balancing itself after a century of defiance. We're watching the same movie history as played before. Different cast, same ending. Every empire believes it's the exception. Every citizen thinks collapse is unthinkable, until it's already happening. And when the US system finally resets, it won't just be numbers on a screen that vanish. It will be livelihoods. It will be identities. It will be the quiet realization that the American century, like every empire before it, was built on borrowed time. Economic collapse doesn't look like numbers falling on a chart. It looks like silence, a factory floor gone dark, a home left half furnished, a father staring at a bank app that won't load. It looks like families lining up outside gas stations and grocery stores, wondering how a paycheck that once felt secure now barely covers a week. This isn't theory, it's history, repeating with a crueler twist. In 1929, suicides rose by 50%. Breadlines stretched for blocks while bankers toasted champagne behind closed doors. In 2008, 10 million Americans lost their homes. Entire neighborhoods turned into ghost towns of foreclosure signs and forgotten toys. Now, as 2026 approaches, the collapse isn't confined to one sector. It's systemic. This time, it's everything. Jobs, pensions, savings, even currencies. Because when the money itself breaks, everything built upon it collapses too. Inflation is the first thief. It doesn't steal visibly, it erodes silently. Groceries creep up by cents, rent by percentages, fuel by dollars. But over a year, a lifetime's worth of savings can vanish. Not through mismanagement, but through design. This is how Weimar Germany fell. Middle-class families who once owned homes ended up burning their paper money for heat. One loaf of bread went from a few marks to billions. And yet, the government insisted it was temporary. That is the same illusion playing out now. The belief that a strong economy can somehow outprint reality. But you can't print oil, you can't print wheat, and you can't print trust. The next wave of pain won't just come from inflation. It'll come from automation and AI-driven layoffs. Corporations already struggling with debt will do the simplest thing to survive: replace people with machines. Millions of white-collar jobs, accounting, marketing, design, even law, are at risk. It's not just factory workers anymore, it's everyone. At the same time, deglobalization is fracturing supply chains built over decades. Nations are hoarding resources, hoarding energy, hoarding control. A single shock, a war, a cyber attack, a failed harvest, could send prices soaring overnight. And the middle class? It'll be trapped between rising costs and stagnant wages. That's how prosperity dies. Not with a crash, but with a slow, grinding suffocation. Most people reassure themselves the government won't let that happen. But governments don't stop crises. They manage them selectively. In 2008, they could have bailed out homeowners. Instead, they saved the banks. In 2020, they printed trillions. But most of that money never reached the people who needed it. And in 2026, when the next crash hits, the same playbook will unfold again. Not because leaders are evil, but because the system rewards saving the system. Governments don't think in human terms. They think in institutional survival. When the moment comes, and it will, the choice will be between collapsing markets or collapsing families. History tells us which side they'll choose. So when people say, "It can't happen here," remind them, it already has. We just stopped calling it what it is. The Great Depression didn't start as panic, it started as denial. 2008 didn't start as greed, it started as trust. And 2026 won't start as disaster, it'll start as normalcy. The same headlines, the same smiles, the same lies. By the time people realize the system they depended on was never built to protect them, it'll be too late. Because in every collapse, the story is the same. Governments save systems, systems save themselves, and ordinary people pay the price. Recessions destroy wealth, but only for those who don't see them coming. For the elite, collapse is never a tragedy. It's a clearance sale. When the headlines scream panic, they see opportunity. When the middle class sells, they buy. And when governments rescue the system, it's not rescue, it's redistribution, from the bottom up. During every major collapse, wealth doesn't vanish. It changes hands. In 2008, as millions of Americans lost their homes, private equity firms like Blackstone quietly bought thousands of foreclosures for pennies on the dollar. Those same homes are now rented back to the public at record prices. One family's despair became another fund's dividend. That's not conspiracy. That's how capital works. And in 2026, the same cycle is preparing to repeat, but on a far greater scale. This time, the shopping list is longer. Entire neighborhoods bankrupt municipalities, even distressed tech companies are up for grabs. Energy infrastructure, water rights, and farmland, the real assets that produce life itself, are being accumulated by those who understand that paper wealth burns, but physical assets survive. While the public clings to stock portfolios, the elite are rotating. They're selling overvalued equities, buying land, energy, and commodities. They're parking wealth in private storage, not digital accounts. They're not chasing returns. They're securing dominance. Most people think the Great Reset is a theory. It's not. It's a cycle. The natural endgame of a debt-fueled system. When leverage breaks, ownership consolidates. You can see it in every crisis. In 1929, bankers repossessed farms. In 2008, hedge funds bought homes. In 2026, they'll buy governments through debt restructuring, privatization, and corporate takeovers of failing states. Because when nations go broke, sovereignty becomes negotiable. Cash, in times like these, is power. Not to hoard, but to deploy when panic hits. Those who hold real liquidity will buy what the indebted are forced to sell. Those holding promises, debt, derivatives, digital illusions, will lose everything. It's not the end of capitalism. It's capitalism's harvest season. And the harvest always comes when the field looks barren. The rich understand this rhythm. Every crisis resets the game board, and they're the only ones holding the dice. They're not predicting collapse. They're positioning for it. That's why family offices are offloading stocks, why central banks are hoarding gold, why billionaires are buying farmland and private energy grids. They're not building bunkers. They're building ownership for the world that comes after. Because once the crash hits, assets don't disappear. They reprice. The stock you panic sell becomes the foundation of someone else's empire. Your mortgage becomes their income stream. Your desperation becomes their leverage. That's the cruel beauty of the cycle. The pain of the many becomes the profit of the few. And once again, the public will ask, how did they see it coming? The answer is simple. They always do. Because they built the system to ensure they would. Every system has a breaking point. And for the global economy, that point isn't measured in dollars or GDP. It's measured in trust. When people stop believing in their money, their leaders, or their institutions, collapse becomes not just possible. It becomes inevitable. We are entering that phase right now. For decades, the illusion held because people trusted the system. They trusted that dollars had value, that banks were solvent, that governments had control. But every illusion depends on faith, and that faith is dying. Inflation has already eroded purchasing power. Debt has destroyed credibility. And leadership across continents has lost legitimacy. You can feel it. Governments bickering while prices rise, politicians arguing over crises they no longer understand, and citizens clinging to hope that someone, somewhere, still knows what they're doing. That's how every empire feels in its final act. Noise, denial, and then silence. Central banks now face two catastrophic options: default or inflate. If they default, markets implode, bonds collapse, pension funds vanish overnight. If they inflate, money dies. Savings become worthless. Either choice resets the system. And the architects of that system, the same ones who created the chaos, will present the solution. That's the part few see coming. Because every collapse has a narrative pivot, a moment when panic is repackaged as progress. In 1933, it was Roosevelt's New Deal. In 1971, it was Nixon ending the gold standard to protect the dollar. In 2008, it was too big to fail. And in 2026, it will be digital currency. When the old world burns, a new one is always waiting in the ashes. Governments and central banks have already been testing central bank digital currencies, programmable money that promises safety, transparency, and efficiency. But what it really delivers is control. Every transaction traceable, every dollar programmable, every citizen's access to money conditional. They'll call it innovation, they'll call it security, but it's surveillance disguised as stability. And the average person, exhausted, broke, and desperate for order, will accept it. Because that's how new systems always rise, through chaos first, then control. Most people think the collapse will look like fire and riots, but it's quieter than that. It's the slow fade of freedom. It's the invisible shift from owning money to renting access to it. It's the moment your savings stop belonging to you and start belonging to the system. And what's terrifying isn't that this transition might happen. It's that it's already begun. Digital IDs, cashless policies, social credit frameworks, all being normalized under the guise of safety and modernization. The reset isn't coming in the future. It's being built right now, line by line, law by law, algorithm by algorithm. The old world isn't collapsing by accident. It's being replaced. The trust that once backed paper is now migrating to code. The same elites who broke the system are already scripting its sequel. And when it arrives, it won't feel like conquest. It'll feel like relief. People won't be forced into it. They'll choose it. Because when order returns after chaos, no one asks who's holding the leash, only that someone is. When the dust finally settles after 2026, the world will not look the same. The crash won't end in chaos. It'll end in clarity, a brutal kind. Cash will no longer be paper. It'll be code. Borders will tighten as governments reclaim control. Ownership of homes, of privacy, of freedom will shrink quietly under new systems designed to protect us. But history has a strange mercy. Every collapse plants the seeds of rebirth. In the 1930s, the Great Depression birthed the New Deal, a desperate experiment that rewired the American economy. In the 1940s, global devastation forced unity through Bretton Woods, anchoring currencies to gold and rebuilding trade. By the 1980s, deregulation and debt-fueled optimism created a new wave of growth. Every collapse writes a new rulebook, and every generation faces a choice. Who writes it? Governments or people? This time will be no different. The next world order will hinge on control of information and money. If states control both, we enter feudalism 2.0, a world of digital serfs, citizens tracked by algorithms, spending restricted by compliance, every purchase a data point, a world where money expires, speech is monitored, and access replaces ownership. It'll be sold as safety, as modernization, as progress, and most will accept it, because after crisis, control always feels like comfort. But there's another path, one built by those who see the cycle for what it is, those who decentralize their wealth, their skills, and their dependence. Those who understand that resilience doesn't come from governments or banks, but from individual sovereignty, the power to survive without permission. Technology is a weapon for both sides. Used wisely, it can free us. Used blindly, it will enslave us. The coming years will decide which future takes hold. Because the crash isn't the end, it's the test. A test of awareness, of courage, of readiness. Every empire before this one believed its dominance would last forever. Every citizen believed someone else would save them. But history doesn't reward belief. It rewards preparation. When the dust clears, a new system will rise. More digital, more centralized, more global. But within that system will also exist a window, brief and narrow, for those who anticipated it to build something freer, fairer, and uncorrupted. That window won't stay open long. The collapse was never the story. The rebirth is. And only those who saw it coming will live not as victims of the new age, but as its architects.